Okay. Muted. Yeah, so good. Do you have exam in any other core units? Looks like we're less people here today. Okay, so today I'm going to talk about capital adequacy. So far we discussed all the bank's risk from the perspective of banks, and now here we want to talk about this bank's risk in terms of regulators' point of view. Okay, so basically what we are going to today is pretty simple. So lengthy lecture notes, but message is pretty simple. You have to understand what is capital, okay, the definition, and how do we measure it, book value or market value, and then what Basel actually say or give some, what guidelines the Basel actually give us about this capital adequacy ratios. So we are starting with this Basel 1, and then see what development made in Basel 2, then what we have now in Basel 3, okay? So that's some sort of historical developments in Basel series. And then under the current regulation in Australia, what kind of ratio that a bank need to meet to say they are adequately capitalized, okay? So we want to know this kind of regulatory threshold. And that's pretty much it, okay? And also we are going to talk about some additional frame or capital adequacy ratio required for the systemically important banks, and then implementing some lessons we learned from the global financial crisis. That's pretty much it. So the content, this is a long lecture notes, but the content is not that difficult at all. So I'll point out which parts you have to memorize, which part you don't have to. So if I don't say you don't have to memorize this, then you have to understand it, okay? So let me start. So capital. What is a capital bank? As you already know now, so you should have some pretty reasonably good understanding of what bank does, right? So they set their capital first, right? They form their capital, meaning bank owner or bank owner actually come up with some capital, and then they actually take the deposit from the general public, right? And then they form a large capital, and then using this capital, they actually distribute loans, right? Distribute this money as a loans, and then using this loan, they can make a profit. Yeah. So that's primarily banking business. Now, because this banking business, so their loans or their assets are exposed to the various risks, right? Interest risk, market risk, forex risk, or what else do we have? Liquidity risk, whatever, right? Different risks, operational risk as well. They have to have some buffer to observe the loss, right? So for example, so let's say a bank a bank you deposited to, the bank actually has a capital of 10% in their total asset, right? So their equity is 10%, liability is 90%. Make sense? So 10% is their own money and 90% is borrowed money, correct? So that's your deposit. Then if this bank actually do their business but made a loss, right? Then primarily that loss should reduce their equity first, right? So they actually reduce their capital. So capital works as a buffer to the like a loss transfer from the bank's business to the liabilities. So your money, right? So once think about what happens if they actually make a loss more than 10%. So they use all their capital, right, to make sure they actually pay out this loss, right? And then if they exceed 10% of loss, then what's happening? They don't have any more capital, then they have to pay this loss using your money, your deposits, right? So that means your deposits are in danger, right? Does it make sense? So to make sure this thing doesn't happen, we need to make sure banks have enough capital, right? Does it make sense? So we actually want to we want to measure capital adequacy ratio for each bank, and then we force them to maintain their ratio above this threshold. Then we can actually make sure this bank doesn't go bankrupt, even though we have some abnormal events like crisis. Does it make sense? That's the whole thing we want to do. So to do that, we have to understand how we can actually define capital first. So capital, conceptually, that's equal to equity, right? Yes? So the money of a bank owner. So money from the shareholders. Also, that should be something like a profit they made, but not distributed to the shareholders. So it's actually retained only within the bank. Does it make sense? So that's their capital. So the other word is a residual claimants on the firm, so the value of asset minus value of liability. So theoretically, this is pretty clear how to define, but practically it's not that clear, because you can observe this equity or capital bank in two ways. One is market value of capital, and the other is book value of capital, right? You agree? So how do you actually calculate the book value of equity? Asset minus liability, right, in your balance sheet. Does it make sense? So that's equity value, yes? Correct? But how do you actually calculate the market value of equity then? Same, asset minus liability, but your asset should be in market value rather than book value. Does it make sense? Yes? So let me clarify this. When you write down your balance sheet for the bank, how do you do that? You actually record the cost or the money you actually lent to someone else. So for the asset side, right, that's a loan amount you made. Does it make sense? Yes? And then for the liability side, what do you record? That's amount of money you actually borrowed at time zero, or let's say like for the particular period, right? Does it make sense? So this is like a historical basis, historical cost basis. Yes? But if you want to calculate the market value of equity, what do? So for each asset, you go to market for this security, and you actually see what's the value of this security today, right? Then you can do this work for all the assets you have, and then you can observe the market price of each asset, right? Yes? And then you can also do this for the liabilities. So you can view like deposits as a kind of zero coupon bonds or whatever, or coupon paying bonds, if you like. So you can go to the market and then, or maybe discounting models, whatever, then you can actually see what's the market value of your liabilities. The market value of your asset minus the market value of your liability should be your market value of equity. Does it make sense? You see the difference? Book value, market value, equity? So that's how you do it. So economists' definition of this equity is like just a net worth of firm. Basically, market value of asset minus like market value of liabilities. But as accountants, using the book value, they use the book value, right? So it's book value of equity. But things are getting worse when regulators actually not using these two or one of this, but they actually using some modified version of this, right? So it's not that clear what is the capital of this bank. This is something that I already explained, right? So the discrepancy between market and book value of capital reflect the market to book ratio, at least partly, right? Yes? So, what is the advantage of using this market value? Think about it. Compared to the book value, what is the advantage? that means, that's true. When your risk factor changes, right? Let's say interest risk is higher, right? You're likely to have an increased interest rate in the future. That's a high interest rate risk, right? And probably you have some forex exposure or liquidity exposure, whatever, right? Then depending on this risk, your market price of the securities, like your asset side or liability side, will be automatically adjusted, right? Then you don't have to worry about the current situation because that kind of risk factors are already reflected in the price. Does it make sense? So this is kind of already risk-adjusted asset and liabilities. Then if you subtract risk-adjusted value of asset minus the liability, right? Then that should be risk-adjusted capital you have, right? So that's like then we can actually say whether this is good enough or you need more. Make sense? But difficulty is here for some securities that banks have, you don't have a market. Think about a loan to a private company for 10 years, right? So think about how easily you can find someone who wants to take over this deal. Does it make sense? So you initiated this loan, but you want to sell this loan to someone else. So someone is effectively, you want someone else actually providing this funding to this company, right? But when this company is private, so less transparent, so they don't have the transparent information system or information environment. And then like we are less likely to assess their credit risk properly, right? And then probably even there some earnings or whatever is not that clear, then you would find it's very hard, right, to transfer this deal to someone else, right? So in that case, you don't have any market for these securities, and that's pretty frequent, especially for the long-term maturity bonds or long-term maturity the loans, right? Does it make sense? So in this case, it's impossible, practically impossible for you to find the market value of assets. Same for the liabilities. Yes? Make sense? So that's one difficulty. And the other thing is what I missed. I know I missed one thing. Yes, that one. So the other thing is, even though, let's say we have all these markets, right? And think about there is a possibility that asset prices, so your value of your assets and liabilities, they are mispriced, right? Then that means your current price do not properly price all the risk associated with your product. Does it make sense? So for example, in theory, this price should be 10, but it's actually 12 now. So it's a $2 difference, right? What does that mean? It's mispricing, right? So even though you observe the market price, it's not necessarily the fundamental value, the true value you should use. Does it make sense? So this kind of possibility actually make us hard use this market value. Okay? So regulators and banks usually use this book value rather than market value. Okay? I also come up with the other reasons why they use the book value. So book value of capital. So it's like managers should keep record of change in assets and liability values if they believe so. The managers tend to differ right off to recognize decrease in asset value. So if you think this is not true, like they want to differ the write-off, meaning they realize the loss at some point, right? So let's say we have a crisis now, right? That crisis. Then you suffer the loss, right? But you don't want to realize this loss immediately, right? Although there's some like a time-consuming process to get some recovery, but still, even though after the recovery, you want to allow some term between your actual loss and the realized loss. Does it make sense? Realizing loss means you actually deduct the amount from your asset. So your balance sheet. Does it make sense? Why do you want to do this? Because your bank manager, the CEO of a bank, you utility function or like objective is different from your utility function or your objective as shareholder. So if you're a shareholder of a bank, what do you want to have? Higher risk-adjusted return, right? Yes? Higher risk-adjusted return, meaning you don't want this only high return. If it is a high risk, high return, it's actually kind of same thing, right? So let's say risk is 10% and return is 10%. But if risk is same, you actually want higher return. Does it make sense? That's what you want. So you don't want to take excessive risk because that means you are likely to lose your money as well. Yes? Well, that's what you want. But what CEO wants is different. What he or she wants is what? Higher salary, longer tenure, right? Or non-pecuniary benefits like good offices or like cars, or private jets or whatever, right? Make sense? So see how much they earn per year. A lot, right? So especially in a year of negotiating their contract terms, right? Like how long they can actually be in a CEO position and what kind of incentive they're going to receive. They don't want to realize this write-off right away, straight away, because once they realize this, their performance measure will be decreased. Make sense? So they tend to defer this write-offs. So the change in risk are not timely and effectively reflected in the capital, right? So that's the drawback of this book value. So the regulatory guideline in terms of loss recognition are necessary under book value accounting. So to reduce this kind of defer of this write-offs and manipulation of earnings, the regulators actually provide some framework to follow. Okay, so this is based on the book value accounting. So as I mentioned, regulators use book value, but they actually adjust it. So why are we actually having we are having difficulties in using this market value? Firstly, this illiquid assets, you don't have market, so you can't observe the price. Yes? And the second is, if you use the market value, that it introduces variability in your earnings. Especially when, first, market price does not reflect the fundamental value, right? Does it make sense? So let's say your asset is actually underpriced. What does that mean? You already purchased, right? But after you purchase, it's underpriced. So you don't really have the correct price. Does it make sense? If you don't have this asset, then you're better off buying this, right? Does it make sense? But once you actually purchase and this asset is underpriced, that's a bad thing. Because your earning will be reduced from this asset, right? At that point of time. You see what I mean? Yes? So it's like this. Let's say you bought a bond, and then once you actually bought this bond, the interest rate actually went up. Then what happened to the price? Going down, right? Inverse relationship, bond price and interest rate, right? Price is going down. But based on theory, let's say it should go down just by 2%, right? But it actually went down 3%. So what your loss at that point of time should be 2%, but because you're using market value, you actually experience 3% loss. Does it make sense? So when market value is not correct, then you are in trouble. So that actually introduces unnecessary variability or variance or risk in your earnings. Make sense? And second, this is also true when financial institutions intend to hold the asset to maturity. What it means that if you want to buy an asset and then hold it to the maturity, meaning you actually make a loan and then you don't want to sell this loan before the maturity, right? Then as long as your counterparty do not default, right? Counterparties do not default, then what you receive is just simply, sorry? In other words, that is promised return, right? Promised return on the loan. That's what you receive, right? Yes? In other, if it is bonds, it's just like yield to maturity. Yes? Does it make sense? So if you hold this bond up to the maturity, then you know how much you will earn, right? So as long as you don't really sell it beforehand, before the maturity, right? Your earning is not fluctuating. Does it make sense? But if you actually use market value, depending on the time, right? You have different interest rate, so your market value will be different. Does it make sense? So it actually introduces unnecessary earning changes for the banks. And that will actually directly affect the CEO's incentive to allocate their money into different assets. Does it make sense? In other words, they are more likely to invest in short-term bonds, right? Meaning short-term loans rather than long-term loans, because the long-term loans actually have larger duration, right? So more interest rate sensitivity. Clear? So I'm actually bringing all your understanding together now, because that's all we have to use for the calculating the capital adequacy ratio. So this is the two reasons why we don't really use the, or we don't prefer to use this market value, okay? So as I said, as a consequence, financial institutions are less willing to take long-term asset exposures, right? Because they are more sensitive to interest rate. So even though interest is changing very small, but your value of asset will changing a lot, right? So at a particular point of time, you have like a large variance in your earnings, which we don't like as a CEO. Does that make sense? Okay. So the capital regulation is based on the book value accounting for most of financial institutions, except for the investment banking industry. So all the discussion we are going to have today, or what we have had today, is about the commercial banking. For the investment banking, it's different, because for the investment banking, what you do is you actually buy usually the secondary securities, right? True? Or you also do the IPO. But anyway, you do have a market for these securities anyway. Correct? Mostly. In that case, you should use market value rather than the book value. And of course, there are some markets that market value is not directly observable. It's like a private equity market, right? Unless someone else wants to take over your position, then you never actually see the market value. Does it make sense? You see or not? No? So think about how you can actually trade private equities. So private equities, you don't have the stock price, right? Yes? You only own what? You only own some cash flow, right? So for the future earnings of company, private company, proportionally. So like depending on the portion of your share for this company. Does it make sense? Yeah? Then once management, private firms management decide how much they're going to distribute, you actually get your portion. Does it make sense? But stock market, so for the public firms, you do have the price of this stock, right? But for the private firms, you don't have, right? So until you actually sell your portion to someone else, you don't really observe the price of this. Does that make sense? That's what I'm saying. So private equities, you don't have market as well, but still, you got some way of calculation. Okay. So why capital adequacy is important? So I briefly explained already. So various risks, such as credit, interest rate, market risk, and that those risks could cause loss to financial institutions, right? So the loss should be observed by the capital, right, first. And once your capital is dried up, then you actually transfer loss to the depositor's money, Make sense? So to make sure we don't really have this, we want bank to have like a adequate amount of the capital to begin with at any point of time. So major function of capitals are actually illustrated here. So the first one is observe unanticipated losses, and second is protect uninsured depositors. So for example, let's say as long as your deposit amount is insured by the government, right? So you don't have to worry, yes? But if you actually have a sufficiently large amount of capital or deposit, which is above the insured amount, right? Then you have to worry about the excess deposit. Does it make sense? The amount above the insured one. So if you have this, then you have to worry about the bank's status, whether they actually doing excessive risk taking or not. Yes? So to secure or to prevent that kind of bank run for this type of depositors, you want to make sure that banks do have sufficient capital to absorb the loss. Okay? And third, protect the financial institution, insurance funds, and the taxpayers. So think about what we had in 2008 and 9. So lots of American, European banks actually bailed out, right? So as they couldn't really provide liquidity by themselves, the governments actually lent their money to the banks using taxpayers' money, right? Make sense? So when we are in bad time, they ask you the taxpayers' money, right? And in good time, they just enjoy their bonus by themselves, right? So look at how much bonus they enjoy in good times. Like a recent period, like from 2010 to 2018. Look at that. They don't share their profit with the general people, right? But in bad time, they ask the taxpayers' money, right? So we actually ask banks to have enough capital to make sure they don't really borrow they don't really cost their consequence of business to the taxpayers, okay? And fourth, and of course, like fourth is like when banks' business is pretty risky, then they should pay higher premium for the depositors' insurance, right? So we don't want to do this. And lastly, to fund financial investment activities. So these days, financial institutions actually do, having the trading book, meaning they actively trade the securities, right? So if they have loss from this trading book, then they want to, they need to realize their loss, and we want to make sure that this is actually from their capital, not our deposit, okay? That's why we needed this capital adequacy, right? Any questions? As I said, easy, right? Nothing difficult. Then we want to move to this Basel Agreement, okay? So Basel Agreement is actually from this. So Basel Committee on Banking Supervision, so BCBS. This is formed in 1974, long ago. So you can actually read through why they actually formed this. So it's actually formed by banking authorities in G10 nations. Their objective was to strengthen the soundness and stability of international banking system while maintaining sufficient consistency that capital adequacy regulation will not be a significant source of competitive inequality among internationally active banks. Do you see what they mean? No? So if they did their job, what that means is if they did their job well, then we shouldn't have had this global financial crisis. Okay, so they failed. That's why they revised the Basel II, and up to we are at Basel III now. So what it means that they want to have soundness and stability of international banking system, because as we are in the era of what's that called? is that called internationalization? Yeah. So we got a lot of trade, international trades, right? And also we got free trading across different countries, different securities in different countries, right? So in and out is relatively much easier than like back in 1990s, right? So that actually means that these finance institutions, internationally active finance institutions, are actually interconnected, right? So the Australian bank actually has some contract with the American bank. American got contract with the European banks and Chinese banks and then other banks as well, right? So that means if one country has a very loose regulation on banking industry, then if this one country's banking system actually broken, then this effect will be contagious to the other country's banking system, then we are in crisis. Okay, we are in disaster in that case. So we don't want to have that, so they actually made this Basel. So this Basel Committee developed the global capital and regulatory guidelines, and governments of each participating nation are responsible for local adoption, implementation, enforcement of guidelines. So Basel Committee only gives these participating nations with some guidelines. So what about doing this? What about doing that, right? In terms of regulation. Yes? And then each participating country actually look at the guideline and they actually set their own regulation by themselves. Okay? So it's not compulsory, but it's a kind of guideline. But many participating nations actually following their guideline, or even in Australia, we actually require more than that. Okay? So I'll come back to that later. So in Australia, APRA is responsible to adopt this guideline and then implement and enforce. Okay? So in Australia, prudential standards apply to all locally incorporated Australian depository institutions. So let me talk about the Basel I first. So Basel I was pretty much about capital adequacy ratio development in relation to credit risk. Okay? So think about how you can actually say a bank is sound or not. Right? They are adequately capitalized, meaning they have enough capital even though we have some adverse effect. Does it make sense? So even though they make some loss, if they are okay to observe this loss. Okay? So that's what we do. So to do that, you actually need to measure the relevant amount of capital, right? So their equity. And then you want to adjust this by the asset they have. For example, for the larger banks, they should have larger capital, right? So the pure amount of capital itself doesn't give us a credible analysis of whether they are sufficiently capitalized or not. Does it make sense? Yes? So we want to adjust this capital a bank has by the total amount of risky asset they have. Does it make sense? So for example, if I have cash only, is this a risky asset? Is there any event that I can actually lose my cash? The only case would be robbery, I guess, right? But that is unlikely almost these days, right? So cash is not risky at all. So cash is not risky asset. You don't want to care, right? But if you have a corporate loans, then corporate loans are likely to default, right? There's some possibility, right? So this is a risky asset, right? Your mortgage contracts and things, they are all risky assets. So we want to adjust capital on our numerator by total risky asset we have, total amount of risky asset we have in denominator. Does that make sense? So capital over risky asset amount. That's the capital adequacy ratio. Does it make sense? We have several versions of this. So this is actually developed in Basel I. But a bit of more detail, which applies to Basel I, II, III, is like this. So as cash is not risky asset, you actually multiply risk weight of 0, right? Does it make sense? Even though you have 1 million cash, you actually multiply 0 because it's not risky asset. So it's not included in your denominator. Yes? What about if you have 1 million corporate loan? It's a risky asset, right? And then if your counterparty is good one, then probably you just include the 50% of risk rate. So meaning half of this asset, half of this money is actually at risk. Does it make sense? And if it's quite risky, then you actually multiply 100. If more risky, then like off the balance sheet activities and things, then you actually multiply more than 100. Okay? I'll give you a bit more information later. So that's how we actually calculate the denominator. We're calculating notional amounts on the balance sheet and off the balance sheet amount, and then multiply by risk-weighted weight. So we just multiply risk weights, and then we can calculate risk-adjusted asset amount. Question? Then this framework only accounted for the credit risk, right? The counterparty risk only. And then people are aware that there is market risk. So apart from this, on top of this, you have to have additional capital when you have adverse market effect. Does it make sense? So that was around 8% top up, okay? But to date, no formal add-on been required for the interest rate risk. So only market risk, you have to have this 8%. Make sense? So that was the Basel I. Then people actually keep develop the guideline, and they thought, oh, we should be able to refine our capital adequacy ratio calculation in more precise way. So we actually develop more categories for the capital adequacy ratio, meaning we actually give more specific guidelines which asset multiply 50, which asset multiply 70s, 80, 90, 100, and more. Does it make sense? So we actually give more specific guidelines for this risk weight. So that's the first thing we actually did in the Basel II. And that one is actually involved with this Standard & Poor's, like credit rating agency. So that's why the credit rating agencies are criticized a lot after or during and after the global financial crisis. So if they actually did right job, then this credit rating should reflect the true credit risk of the borrower, right? Then we shouldn't really have this. We shouldn't have had this this financial crisis in 2008. Make sense? But what happened was, as discussed last lecture, I think someone actually asked, if we have to pay credit rating agency, how come they can actually give us a low rating, right? Because I'm a borrower, right? And you are the credit agency. Then I go to you, and then you actually gave me bad rating, and I just kick you out. And then I actually go to the other one, and then he actually gave me the bad rating again. I kick him out again. And I go to you, and you actually gave me a good rating, and I just use this rating. Does it make sense? Then I can actually fund my money at lower cost. Does it make sense? So this practice actually inflated credit ratings of borrowers, right? So like loose lending has happened, and then we actually have this kind of inflated credit rating. So that actually created this kind of mortgage crisis in U.S. market, right? And then that became international problem when, especially because U.S. bank actually lied on credit contracts with the European banks, okay? And the other development of Basel II is that they actually explicitly specify operational risk. But this operational risk is relatively less important than the risk we actually covered. So I don't think we do cover here. So this diagram actually gives you a pretty good understanding what's the difference between Basel I and II. So Basel 1, they actually developed the credit risk adjustment for the capital adequacy ratio, and then traded market risk, right? So they have to have 8% add-on capital adequacy, right? So for the market risk. And Basel 2 actually added operation risk as a new stream. So they actually require additional capital for this operational risk. And also they actually developed more like formalized or like more precise steps to calculate this credit risk, credit risk based capital adequacy ratio. Okay? Any question? So you know what's happening in Basel 1 and 2, right? It should be pretty clear. So, Basel 2 got 3 pillars, meaning they have, this Basel 2 has 3 main objectives. First, they want to calculate this capital adequacy ratio based on credit risk very well. Okay? So that's why they specify, like they detailed all this kind of risk weighting for different assets, right? Because they want to come up with a more accurate capital adequacy ratio. So Pillar 1 covered regulatory minimum capital requirements for credit market and operational risk. Okay, that's Pillar 1. And Pillar 2 is actually encouraging regulators to put more effort in supervising and enforcing the capital adequacy ratio. Okay? So for example, even though the regulator actually set this capital adequacy ratio, so you actually say, oh, your capital adequacy ratio should be greater than 10% or 12%, 30%, right? But if you don't look at it and then you don't penalize the banks who actually violate this, then why do they need to follow, right? Does that make sense? So you have to enforce this, yes? So that's the second pillar. So they actually stress the importance of regulatory supervisory review process as critical components of minimum capital requirement. Make sense? And lastly, it's related to the last section of our lecture last week. This Basel 2's last pillar, third pillar is this. So by force banks to disclose more information about their capital adequacy ratio, their risk exposure, their business models, whatever, then depositors like us can actually see banks' information, and then we can actually determine whether this bank is good or bad in terms of their capital adequacy ratio, right? Yes? So the ratio is simple enough. You actually see the capital adequacy ratio. If this is less than some threshold, then you can say that, oh, this bank is not sufficiently capitalized, meaning your deposit is more likely to be in danger. Yes? So then what do you want to do? If you have a deposit under the insurance value amount, right? Then maybe you don't care, but if you have a large amount, right, above the insured amount, right, then probably for the excess portion, you want to move this portion to the safer bank. Does it make sense? That's what you should do. So meaning we want to create one additional disciplinary force for the bank's action. Does it make sense? So if you have this disciplinary action from the depositors, then bank should actually disclose their information clearly, and then they should exercise some effort to meet this capital adequacy ratio, right? So they don't really take the excessive risk. Does that make sense? Yeah? So we want to create 2 forces to make sure bank actually running in the right way. First is regulatory supervision. So like they put the fines, and then they actually put their operation, some regulations on their operations and things. And second is actually market disciplinary effect. As the depositors, we can actually see the information, we can actually move our deposits accordingly, right? So then the bank should be governed in that way. Make sense? That's it. That's Pillar 1 to 3. So this is something that I already told you. Because of this inflated credit rating before the global financial crisis, this Basel II framework didn't work. Okay? And also, during the second point, during financial crisis, loss due to market risk was significantly higher than minimum market risk capital requirements under the Basel II. So we actually asked the banks to have additional 8% of capital, right, to meet the market risk. But turns out that they should save more than that, right? Because the global financial crisis actually blowed almost 30 to 40% of the capital anyway. So they should actually have more than 8%. And third, Basel II capital adequacy formula for credit risk was pro-cyclical, meaning it's actually already declining before actual crisis actually comes. Okay? Then once you actually see the crisis, then default is higher and the loss is higher. You can't do anything. Right? Does it make sense? So that's what's happening. So what it means that it's actually kind of explained in that graph. So the blue one is 2007 and red dot, like the point is 2008. So you know that people usually think global financial crisis actually started from 2008 and ended 2009, right? 8 and 9, and 2008 we had the Lehman Brothers default, right? So people usually think that is the global financial crisis, but it's not. So this global financial crisis actually started by the announcement by BNP Paribas. Have you heard of this name? BNP Paribas? That's one of the global banks. Okay, so they do investment banking, they do commercial banking. I don't know exactly where their nationality. I think it's France or somewhere. Yeah, it's a European bank. So what they announced in middle of 2007 is they are not going to provide any line of credit to the US banks because of the potential increased risk in the US residential market. So like a mortgage market. Does that make sense? They announced this in their annual statements. So what it means that they don't want to make any transaction in relation to US mortgage market with the US bank. Yes? Because they thought that became too risky now. So that is announced in the middle of 2007. Then the graph over there, red line, right? So in middle of 2007 is specified by the blue color there. Then after they announced this, we actually see the slight increase in the credit risk plus liquidity risk spread. So it's like a market general. So think about this way. In the market, you perceive some credit risk and liquidity risk, right? Does it make sense? That's kind of a general risk you actually perceive at market level. Then this risk was almost zero before, but once this BNP Paribas actually announced that this is actually started to increase. And then it moves a bit of increased amount like that. Then once the Lehman Brothers actually defaulted, then this index actually skyrocketed. We haven't seen this level any time beforehand. Okay? So what it means that in 2007, crisis already started, right? But at that time, European banks and American banks had enough capital. But as long as one influential bank actually announced that I'm not going to trade you anymore, then this market is already freezed. So even though you got some fund, you're not willing to lend this money to someone else because you're worried about credit risk, the counterparty risk, and liquidity risk, right? So that means you had to fire sale your illiquid asset because at that time, these banks European banks and then US bank didn't have enough liquid assets. Does it make sense? So your only option was to store the liquidity management, not borrow the liquidity management, right? So that's why they couldn't really meet the liquidity needs at that time. So once this mortgage market actually collapsed in the US, then all the US banks needed credit, right? So they actually exercised this line of credit contract with the European bank. But of course, no one wanted to lend money to these guys. The European bank actually couldn't really meet these requirements. So that's why we had this global financial crisis. So at the early stage of the financial crisis that began in 2007, although many banks had adequate capital level, they nevertheless experienced difficulties because they did not have adequate liquid assets, liquid capital, right? That's what happened. Any question? I think I explained this one several times, so you should have some clear idea what happened. So by paying a lot of costs in the global financial crisis, so for some countries, the cost they paid during the financial crisis was like 40% of GDP. 40% of GDP, like the US. You see how big it is, right? Does it make sense? 40% GDP was gone as a cost, right? So because they had to bail out, they had to reduce tax, whatever, things like this. So we actually paid a lot of money to get lesson. Then this Basel committee actually revised their Basel II accordingly. Okay? So I think it's kind of okay, but still we have to improve that quite further. So its goal is to raise the quality, consistency, and transparency of the capital base of banks to withstand the credit risk and strengthen the risk coverage of the capital framework. Okay? So this Basel III made some improvements in each pillar, but we want to focus on the very first one, measuring capital adequacy ratio in relation to the credit risk. Okay? So what they improved in Pillar 1, raise the quality and quantity of capital with the focus of common equity. So with the focus on common equity, that's important. So they require significantly higher capital requirements for trading and derivatives activities and substantial strengthening of counterparty credit risk calculation in termination of required minimum capital. What it means that they realized the risk of these off-balance activities is much larger than they thought before, right? So they actually incorporated this off-balance sheet activities in Basel II, but risk weight for these assets was much lower than what they should be. So they corrected this. Okay. So that's the first thing, and introduce internationally harmonized leverage ratio to serve as backdrop to risk-based capital requirements. So what they do is they do not want banks to rely too heavily on the leveraging, meaning term fundings. So for example, what they want is if you do the commercial banking, then they want you to fund from the depositors, right? And then you actually manage your liquidity risk somehow well, but you don't really rely too much on the borrowing from the other banks and things. If you rely on this borrowed risk management too much, then once market is freeze, then you're done, right? So that's the internationally harmonized leverage ratio. And third, introduce a capital conversion buffer, which should build up in good times, and countercyclical buffer, which should be built in during the period of excess credit growth. So these two things is kind of same way. So for example, what they did before the global financial crisis is they experienced a lot of growth, right? You can actually look at the stock price of bank from 2000 to 2007. They increased like this, right? But what did they do? They enjoyed huge salary. They enjoyed a huge bonus, right? But they didn't really secure some of their profit as a kind of capital, right? So like as a buffer when you have a bad time. So they enjoy the high salary, they enjoy the huge bonus, but in the good time, but they don't really share with us. But in the bad time, they want to get our tax, right? Does it make sense? So this is a bad thing. So we actually require them to save some money in good time for the rainy days, and then use that money, use your money if you are in trouble. That's what we require. Does it make sense? So that can actually reduce the cost of a crisis somehow. So that's actually two things. So first, in your good time, then you save something, and especially when your economy is in very huge expansion, meaning money is circulating a lot in the economy, then you are more likely to earn more money, right? Then you actually reserve some of this money as a buffer, and you actually use it for the rainy days. Okay? So that's two things, but same logic. And introduced minimum global liquidity standard to improve banks' resiliency or resilience to acute short-term stress to improve long-term funding. All right, so that's pretty easy to understand. And then introduce additional capital surcharge for systemically important institutions. So this is something I introduced before. So we are in the era of globalization. So we have lots of international trading and lots of investments across countries and cross-border. So inevitably, all the largest banks, different nations, they actually have some transactions, right? Does it make sense? So for example, I don't think that's the right one. For example, let's say we have in Australia ANZ and NAB. What else do you have? Westpac and Commonwealth, right? Combank. And US and Europe, we have Bank of America, Wells Fargo, and then what else do we have? Morgan Stanley and JP Morgan and Goldman Sachs, right? All these large banks. And Europe's, we have UBS and Scotland Bank, so RBS, Euro Bank of Scotland, and then what's it that? What else do you have? European Bank. Sorry. Yes, Deutsche Bank, and something else, right? Then let's assume that we have lots of trade, international trade. Then if Australian companies actually exporting a lot to these European countries and American countries, right? Then they have to have some foreign currency, right? Then what they usually do is they can actually do spot trading, but they don't want to be exposed to the spot risk, so they actually get into the forward contract, right? So meaning some of them is actually getting a lot of contract between the two, like here as well, right? Then if you actually visualize the connection between the banks, then let's say some bank, let's say Bank of America, right? And here we have, so the size of a circle is representing the asset size, okay? And here we have NAB. And here we have UBS. And then we have some smaller banks in Australia and smaller bank in, it's just a conceptual demonstration like this. Then if you want to draw the business relation between the two banks, then you may just think like these kind of lines, right? That would be better. If you have these solid lines, that means you have more business relation with other banks, right? So meaning this Bank of America is systemically more important than this or that. Does that make sense? Because they have more connections with other banks. Then if this one actually bankrupt, it doesn't matter that much because it's like it's affected the Bank of America a little bit and then NAB a little bit, but it doesn't really affect the other banks, right? But if Bank of America default, then this affected this, and that almost all banks are affected, right? So we actually call this bank, so Bank of America, as a systemically important bank, and especially at the global level, globally systemically important bank. Does it make sense? So for those banks, we actually require additional capital. Okay? So it's like as long as you're larger and you're more important, then we actually require for you to have more capital. Does it make sense? That's basically it. So how Basel III improvements in Pillar 1? What do they actually calculate? You actually calculate this. So CET1, risk-based capital ratio. So that is a common equity Tier 1 capital ratio, and Tier 1 based capital ratio and risk-based, total risk-based capital ratio, and then sometimes, not sometimes, but you also have a Tier 1 leverage ratio. Okay, so what you want to do is like you want to measure this four. And for the market risk, as we actually learned last week, we want to calculate expected shortfall. So value at risk was already in Basel II, but it turns out that it didn't work because it doesn't really calculate the kind of average loss you're going to have because you exclude all the possibility on the far left. Do you see what I mean? So let's say if this is your distribution, this is a return distribution, right? And then if you calculate VAR, 5%, then this area is a 5%, right? And then you only say, oh, this is, we have 5% chance that we have, let's say this is negative 10%, right? Yes, that's the value of risk. But if you calculate expected shortfall, meaning you got a negative 20% here, negative 30% here, right? Then depending on the area probability, you can actually calculate expected shortfall, meaning what is the average loss you're going to have with a 5% chance. Does it make sense? So it should be like a more than 10%, like a negative 20%, if you calculate the expected value under this area. Does it make sense? Do you remember what we did last week? Yes? Good. So this expected shortfall concept actually incorporated in Basel III. And Pillar 2 and 3 is for your knowledge only, meaning it's not examinable. Okay? So which is good news for you. So Pillar 2 call for enhanced incentive for banks to better manage risk and return over the long term, more stress testing, implementation of sound compensation practice. So it actually requires more intervention of the regulators. And Pillar 3 calls for enhanced disclosure of risk, such as relating securitizing exposures and then sponsorship of off-balance sheet vehicles. So what it means that before, you only reported the capital adequacy ratio in Basel II, under the Basel II, you only reported the capital adequacy ratio, which didn't really count for the correct risk of the off-balance sheet activities. But now you want to disclose more about the off-balance sheet activities, which is not observed by your asset balance sheet, right? So you want depositors to be informed in better way. That's the Pillar 3. So this diagram is actually illustrating what they did in Basel III. Okay, so I already mentioned everything here. So you can actually, if you don't know, or if you don't have clear structure what I said, then you can actually just refer to this. Okay. Then now we want to know what is our local regulation in Australia. So Australia's risk-based capital adequacy guidelines are generally consistent, but not completely aligned with this Basel guideline. Okay, So you may think that we actually far below the standard, but it's not. We are far above the standard. So we are more stringent. Okay? So APRA has exercised its discretion in applying Basel framework to Australian depository institution, resulting in more conservative approach than minimum standard published by BCBS. Okay? So APRA also introduced the new standard from the 1st of January 2013. So now we want to know how to calculate capital ratio. So as I said, capital ratio is on the numerator, you have measure of capital, and then denominator, you have a measure of asset, right? Yes? That's what you want to have. So the practical question is how to measure capital, how to measure assets. Okay? And then this Basel agreements, a court, provides you exact way what to do. So this Basel agreements actually aims to provide a unified framework to answer both questions. Okay? So basically you have two ways. Well, you have two ways to, I think. Yeah, I think the order is somehow corrupted. Yeah, it should be this. So you have two ways to calculate this, or correctly calculate this capital adequacy ratio. First, you want to reflect associated risk to your asset in your numerator. So if you have a higher risk, then you actually require higher capital. Does it make sense? Do you understand what I'm saying? So basically, what you want to have capital ratio, right? Capital ratio. Then your capital, you see here, numerator, and then your asset is the denominator, right? But if you only use the capital like your book value of capital, right, in the balance sheet, and then all the assets you have in your balance sheet asset, then it doesn't really properly reflect what you actually have. Or it's not kind of a measure for the capital adequacy we want to measure, because what you have is not risk adjusted. Does it make sense? Do you understand what I'm saying? So equity here, so capital, that can be simply calculated as an asset book, so your balance sheet, that's actually equity value, right? Yes? Equity plus your retained earning. That's capital. And then if you just put the asset value you have on the balance sheet, firstly, you're completely missing off-balance sheet activities, right? And second, you didn't really adjust the risk associated with each asset. Does that make sense? For example, you have a cash item in your asset, right? It's not risky at all. You have to deduct this. Does it make sense? So if you have some sort of risk, like interest rate risk and market risk or what else? Operational risk, liquidity risk, whatever, then one way is you adjust your capital depending on this risk, right? But that thing is not that clear. If you have a higher liquidity risk, how much you actually have, how much you have more capital. Does it make sense? So easier way is you actually adjust the denominator assets. So if you have more risky asset, then you actually increase your denominator, then you have lower adequacy ratio. Does that make sense? Meaning you are less capitalized to meet adverse effect. Does that make sense? So that's what we do. So we don't really touch the numerator, we actually touch the denominator. So how do you do that? We actually multiply notional amount of your asset by risk weights. Okay? So for example, as I said, cash is riskless, right? Yes? Then you don't want this cash to be included in your asset, risky asset, which is denominator, right? So you actually give 0 weight. Meaning, regardless how much cash you have, you don't really include it, right? And if you have corporate loans, that's risky asset, right? Then you want to give them 100% because probably at the worst case, you're gonna lose all the money, right? So that's 100%. Or if you have some off-balance sheet activities that's much riskier than the on-balance sheet activities, then you want to give them 1,000% risk weight, okay? So even though it's just 1 million, you got a potential to lose it more than 1,000. Does that make sense? So you want to give them more than 1,000 risk weight. Does that make sense? Yes? That's what we do here. So more risky assets are associated with a higher rate. So effectively, higher level of capital is required for assets with a higher risk. I don't know why this is corrupted. Then this should be here. So it's like this. So this is your denominator, which is credit risk adjusted asset. That is simply your asset notional amount multiplied by risk weight. Yes? So cash, that's 0, right? For the corporate loans, that's 100%. If it is some off-balance activities, then you have 1,250%. Okay? Something like this. So we talked about the denominator, then we want to talk about the numerator, okay? So common equity, tier 1 capital, there's two things. First, that's money from the shareholders, right? And second, retained earnings. Make sense? There's two sources. And additional tier 1 capital is like a non-cumulative perpetual preferred stock and related surplus. So this is a kind of additional like buffer you can actually use when you have some loss. And tier 2 capital, a broad array of secondary equity-like capital resources. So it's like a convertible loans, subordinated loans, and then some unqualified perpetual preferred stock. Okay. So you can actually see here, your tier 1 capital is equal to common equity tier 1 capital plus additional tier 1 capital, which is perpetual one, qualified. And then total capital is equal to tier 1 capital plus tier 2. Tier 2 is here, right? Does it make sense? So your total capital is equal to tier 1 plus tier 2. Probably we have the typo in your lecture notes, so remove this one. So tier 1 plus tier 2. And more detailed about this is actually here in your textbook. So if you're interested, look at it, but it's not examinable. As long as you know this context, you're fine. So once you have this numerator and denominator in your capital ratio, then we can calculate these 4 different things. First, CET1 risk-based capital ratio, and tier 1 capital ratio, total capital ratio, and then leverage ratio. Okay? So depending on the risk level or like the capital definition, you have different ratio, right? And then we actually give different threshold for different capital ratio. So first, CET1 capital adequacy ratio. If you want to say your bank is adequately capitalized or adequately funded, then you should maintain more than 4.5% of this ratio. Does it make sense? And tier 1 capital adequacy ratio, you should have more than 6%. And total risk-based capital ratio, that's more than 8%. And then leverage ratio, that should be greater than 3%. And total exposure will be covered soon. Okay? Does that make sense? So that's the threshold for each capital adequacy ratio to say that your bank is adequately capitalized. Okay? So we have harsher threshold, meaning higher value than those. Then you can actually say you are fully, like there's some different terminologies used, but you can actually say in that case you are fully capitalized, right? Or unquestionably capitalized. So using these terminologies, you have different threshold, but as long as you understand this first, so you have to understand, memorize these numbers, but you should be fine. So I strongly recommend you go through the practice questions on Moodle. Then as long as you can solve their questions without looking at textbook, you're good for the exam purpose. So what we've done so far is like is an approach for the capital adequacy ratio for any bank, but we didn't really specify how we calculate. So this is pretty straightforward for the on-balance sheet activities, right? On-balance sheet item, but we didn't really talk about the off-balance sheet item yet, right? So we want to know, so what I mean by that is, when you want to calculate this denominator, you have on-balance sheet items plus what is it, OFS, is it? Yeah. So off-balance sheet item, right? So you have two things. So this is pretty straightforward. What you do is you multiply risk weight for each asset and multiply by notional amount, right? So this is straightforward. But here, we can't do this because we do have a notional amount, but depending on the off-balance sheet activity type, you have different contract. So in general, we can actually classify them into two. One is derivative, the other is contingent. The contingent means your counterparty has an option to exercise something. For example, line of credit or commitment of loans. So if you have a line of credit contract with a counterparty, if your counterparty asks you funding, then you have to provide it, right? So you don't know whether they will exercise or not, right? So that's different from your option position, right? So we want to differentiate these two. So that's risk adjustment for the off-balance sheet activities. Okay. Yeah. So capital requirements under the Basel III, ultimate objective is to require deposit institution to maintain a minimum level of capital, observe potential loss, and protect liability holders. So that's something we already discussed so far, I mean, very extensively. And then your risk weight will depend on this credit risk of counterparty, and then the number of risk weight categories, ways, and specific ways of classifying different assets into weight categories could differ from country to country. Because what Basel III actually provides is like a guideline, right? And maybe local specific situation would differ than the body authorizing the authority, the local banking authority will actually have some discretion to adjust this. So from country to country, you have different different treatments. But in general, cash is not really included in this. So you can actually have a look at it later. But let me just go through it briefly. So you can actually see category 1, that's actually cash, right? And then all the other Federal Reserve Bank balance and direct and unconditional claims on the U.S. governments, right? So it's like just a direct loan to this U.S. government. So they are like you can use as a cash. So you don't have any risk because your counterparty will not default anyway. Make sense? And if you have very liquid and also more likely to default but not that much, then you actually want to put 20% risk weight. So items is like a cash item in process of collection, but there's still a little possibility that you cannot collect this item, right? And then like government-sponsored entities like GSE, and then U.S. deposit institutions and things. So you actually interbank lending, right? So that's actually 20%. And 35% is family residence and mortgage. And also you have the exactly same thing here, which is a 75%. And you got another one from the same one for the 200%. So you got the same item for like a residence and mortgage, starting from 35%, increasing 75 to 200%. Do you understand why? What would be the reason? So when you want to buy a house, you want to get a mortgage, right? Because you usually don't have enough money to buy a house by yourself, yes? then I assume no one here bought house yet, but you will do in near future, so I'll let you what to do. So basically, you have to save some money for the down payment. So down payment is like you have to pay some portion of the house price. Does it make sense? If you want to buy 1 million house, then you have to pay 100,000 bucks at least. So that's a down payment. Does it make sense? So you only finance 90% of your house price through the bank, with bank. Does it make sense? So you pay 10%, bank pay 90%, then you buy a house. Does it make sense? Think about this contract and compare this one with that. I mean, the example I'm actually illustrating now. So now, you want to pay 40% for the housing price, and you only borrow 60% of house price from the bank. Okay? Which one is riskier from the bank's perspective? Why? But it's a asset backed, right? So like if your mortgage holder cannot really repay, right? If I borrow my mortgage from you, and if I cannot pay back my mortgage, you can just get my house and then sell it in the market, and that's done. So it's a secured loan anyway, right? But we still have some mortgages are actually just 35%, some mortgages 75%, some mortgages are actually 200%. Why? You're right, but you don't know, you didn't really give me precise reason why that is more risky. I mean, the first one is more risky. It's not based on personal situation. Any other thought? So what she's saying is, mortgage loan, we actually typically loan to value ratio. So value is the housing price, right? And then loan is how much you actually lent, right? If this ratio is high, it's riskier loan. Yes? Because the borrower, mortgage holder actually borrowed more from you. Yes? Why? What do you mean? So that's kind of a personal situation, right? Yeah. But if from the first place, if they cannot really repay back, right? They cannot pay back, then you're not going to approve this lending, right? Think about when your mortgage holders, your borrower, cannot repay your loan. Think about the global financial crisis. What happened? Good. Then, so economy is going bad, right? Then many people actually lose their job, right? In a short period of time. Then you have increased bad debt, right? You have to sell these houses, right? Does it make sense? Then what's happening to the housing market? You have more buyers or more sellers? More sellers. Then what happened to the house price? Go down, right? Then think about this case. You actually borrowed 100% of a house price from the bank. Then after you actually approve this loan, then like the economy went bad, and then the borrower cannot really repay back. And what you should do is, you haven't received any payments yet. What you should do is you actually get the house from the borrower, right, and then sell it to the market, right? But we already have a bad economic state, right? then your housing price is not the amount you actually lent. It's actually less than what you lent, right? Meaning you cannot recover this loss. So for example, let's say you actually lent 1 million, but now you can only receive 0.9 million by reselling this, right? Then if you don't have this lump sum payment before, the loss is actually on your own. You have to get this loss. Does it make sense? If you have 10% lump sum payment, meaning you sell it at 0.9, you actually take all the 0.9 because you actually lent 0.9. Does it make sense? The loan to value ratio is 9%, so you already have 10% buffer, so you don't have to experience this 10% drop in housing price. Does it make sense? What about if you have 20%? Then unless the housing price drop is up to the 20%, you don't have to experience any loss. Make sense? And what about the 40%? It's very unlikely that housing price actually to be half, almost half, right? Drop down by 40%. Does it make sense? So you are safer in this case, right? So when residential mortgages are actually having lower loan to value ratio, yes, then this risk weight will be lower. Does it make sense? That's why the first one is 35%. And if you're actually between 70 to 80, then you're actually adding 75%. And then if you only have 90 to onwards, to the 100%, then the category is a 200% risk rate because it's a more risky asset. Does it make sense? Same thing applies for different loans, like your sovereign debts, like you're actually lending money to the foreign governments, right? And if you're actually lending money to, let's say, which country would be appropriate? I don't want it to be personal, right? So this is not my thought, but let's say we actually lend money to Greece, right? And think about lending money to the Japan or China or whatever. Then Greece, they already in crisis, right? Then you are less likely to get your payment back, right? Does it make sense? So then you have to put a more higher weight for this debt, even though they are same foreign government debt. Does it make sense? So that's exactly what we do here. So you can actually see it, depending on the loan to value ratio, if it's greater than 90, that is 200%. And here, there's this. And here, there's this, right? And this is like a category 2 mortgages. If you got some sort of different guarantees from the government, then it becomes much lower. Okay. And here, that's what I said. So depending on your credit risk of your foreign government, if they are lower, then it's a higher. If they are actually more credible, then you actually don't give any weight because they are governments, right? Make sense? So same thing here, foreign banks. So in Australia, APRA announced an increase in the amount of capital required for Australian residents and mortgage exposure by authorized deposit-taking institutions in July 2015. So that actually increased approximately 16 to 25% in their risk-adjusted asset amount. Does that make sense? Sorry. So, and also, APRA announced the changes to minimum requirements for CET1 capital in 2017. So you remember, this CET1 capital adequacy ratio by Basel III was 4.5%, right? That is actually the status for the adequately capitalized. So if in Australia, for big 4 banks want to claim that they are unquestionably sound, right, then they should exceed this CET1 capital adequacy ratio above this 10.5%. So much harsher than the guideline. Does it make sense? Maybe that's why Australian banking system is sound, but we don't know what kind of bad thing they are doing. Okay, so we move on to these off-balance sheet activities. Okay. So we have two types. One is contingent claim, and the other one is derivatives. Yeah? So contingent claim, which is like a loan commitments, letters of credit, and line of credit, whatever. And derivatives is like futures and options forward swaps. Okay? Clear? So for the contingent claim, we have two processes, or in general, for the off-balance sheet activities. First, you actually need to convert notional amount of your contract into some sort of balance sheet item on the balance sheet item equivalent amount. Okay, so convert off the balance sheet value into on the balance sheet credit equivalent amount. Okay, so that's the first step, and then assign off balance sheet credit equivalent amount to risk category. So you actually assign some risk weight. Does it make sense? So the second step is the same as on the balance sheet. So the first step is the additional step you have to have for the off-balance sheet activities. Does it make sense? So for example, we talk about the contingent claim first. So let's say we have 10 people here, right? And I'm a bank, yes? And you have a line of credit contract with me. So I have 10 of this, yes? And then each one has 1 million. So meaning, if everyone actually exercises this line of credit, then I have to provide 10 million. Does that make sense? Yes? That's notional amount. But maybe, on average, only 20%, meaning 2 out of 10, only exercise this. Does it make sense? So I just want to convert this line of credit 10 million into some realistic value as an on-the-balance sheet item. Does it make sense? So this is kind of a probability that your counterparty will exercise this option. Make sense? So the first step for the contingent claim is usually multiplying the conversion factor to your notional amount. So my notional amount is 10 million because I have 1 million contract 10 times, right? So that's 10 million, that's my notional amount. But my conversion factor is 2.2 because only usually 2 out of 10 is exercised. Make sense? So in final amounts, on the balance sheet equivalent amount should be 2 million. Does that make sense? And then I just assign the appropriate risk weight for this 2 million, multiply it together, and that's it. Yes? And sum them up. So that's this. So off-balance sheet contingent claim amount, and then you multiply conversion factor. Then that's a credit, like a credit equivalent amount, or on the balance sheet equivalent amount. And then you actually multiply the risk weight. Okay? That's clear. So for example, say this. So if you have unused portion of loan commitment with original maturity of 1 year or less, then you have less period left for your counterparty to exercise this option, right? And some of the amount is unused. Then you actually give conversion ratio of 20%. But same thing, exactly same commitments, but the maturity has more than 1 year. Then you got a longer period, then you know what will change in the future, right? So probably the conversion or exercising of your counterparty will be higher than the shorter period, right? So we actually give 50%. Does it make sense? Yes? Clear? So this kind of a probability will be given in your question anyway, so you don't have to memorize it. Okay? And derivative contracts are a bit different. So it's different because the payoff or the commitment amount from your side is calculated in a different way. So for example, let's say you have stock option, because the stock option is like core option. That's the most familiar concept you have, right? So if you have, let's say, stock option of Apple, and then, do you know intrinsic value of option? Yes? So let's say you have stock option, then your payoff and this is the maturity stock price, underlying asset price, right? Then it should be this, and this is your X, right? Does it make sense? And you bought this. Of course, if you account for the premium, then it should be something like that. Yep. I don't want to. Yeah. So basically the distance between your x-axis and then your y, the line, that should be the intrinsic value, right? If you exercise this today, then how much you actually get. Make sense? So that is kind of the current position or current earning or current profit from this position, right? Does it make sense? And let's assume that you have 3 months left for the maturity. Yes? Then your current exposure is actually 0 because you have a positive profit. Does it make sense? You don't have any current risk. If you actually sold this option, right, then what does that mean? Your payoff is like this, exact opposite, right? Yes? If you sold this core option, does it make sense? Because it's zero-sum game. If you actually earn money because you actually bought this core option, then I sold it, so I have to pay for this. Does it make sense? So if you actually overlap this, there should be exactly overlap. Okay? Fold this, exactly overlap. So if you actually sold this core option here, then probably, so not probably, then your current exposure to this option position is what? Is negative, right? Does it make sense? So that is like our current exposure to this option. But even though you have positive current exposure, meaning you don't have to, even though you actually earning money from this position, it doesn't mean that your future exposure, like or the amount of loss, is 0. Does it make sense? Because your time period left is 3 months. Within these 3 months, if this stock price is actually going down, then you're likely to lose your money as well. Make sense? So you want to calculate this future exposure and sum them up. Then that is our total exposure for the derivative contract. Yes? So what you do is this, potential exposure plus current exposure. So current exposure is how much money you are losing now. Okay? And potential exposure is how much money you're going to lose with some probability. Does it make sense? That's how we calculate this. Then we actually assign this risk probability for these amounts, and then you multiply it together. That's pretty much it. So how do you actually calculate the potential exposure? It's simply this, again. So notional amount of contract, if it is like a 1 million Forex swap, then that's 1 million. And then conversion factor is 0.2, then multiply 0.2. Then that's 0.2 million, right? That's potential exposure. And plus how much money you are earning or how much money you are losing. Does it make sense? If you are earning money, then we actually set it as 0 because you don't really have any loss at the moment. So we actually set your potential current exposure as 0. But if you're losing money at the moment, then you actually put the positive number there. Does it make sense? That's what it says here, replacement cost. So think about what replacement cost is. So let's say if your counterparty actually goes bankrupt, then you have to find someone else to replace your counterparty, right? Yes? And then how much cost you actually need to pay by replacing this. Does it make sense? So this thing, replacement cost, is not a matter if you are trading standardized futures and options and forwards, not forwards, just standardize the futures and options and then swaps, right? Because you have exchange, yes? Then you have mark-to-market mechanism every second. So you don't have to bear any kind of credit risk or counterparty risk in that case. But you do have this replacement cost if it is non-standardized contract, for example, forwards. So if your counterparty defaults, then he goes away, then you lose this current amount, right? Then you have to find someone else. Does it make sense? So that's replacement cost. So rather than talking by words, showing you the example would be more beneficial, right? So here it's like a conversion factor for derivative contracts. So interest rate contracts less than 1 year, then there's a 0%. Exchange rate contract less than 1 year, 1%, or 1 to 5 years, 5%, 7.5% over the 5 years, right? So as long as you have a longer period, then you're more likely to lose some money because of volatility, right? So you actually increase the conversion factor. Make sense? Okay, now I want you to focus on this numerator first. Is that big enough? Yes? Can you see at the back? Okay. So think about how we can actually calculate numerator of this capital adequacy ratio. So the first one is called Common Equity Tier 1 capital, right? Yes? That's primary source of your equity. So what you have is that the amount from the shareholders and some amount retained earning. Yes? So you can actually see this common stock is classified as a CET1, right? And the retained earning is also CET1. So if you want to calculate CET1 capital, right, that should be simply 70, right? What is the additional Tier 1 capital? That's qualified perpetual preferred stock, right? So that's this. That's an additional Tier 1, which is this, right? So if you want to calculate Tier 1 capital, that's 80, right? 70 plus 10 is 80. Make sense? What about your Tier 2 capital? You got 5 million here, perpetual preferred stock, but it's non-qualifying. Okay? You got some rules for this, but you can just perceive it as a given. And then convertible bonds and subordinated bonds, that's actually kind of Tier 2 capital, right? So that's 20 plus 5, then there's 25, right? Then what's your total capital? Should be Tier 1 plus Tier 2, that is 105. Does it make sense? So that's what you calculate here. So 70 for CET1, and 80 for the Tier 1, and then 35 for the Tier 2. Then total capital is 115. Okay? So now, yeah. Oh, sorry, I missed this. Tier 2. So this one and that one and that one and this. That's reserved for the loan loss, right? Was that what you wanted asking? Okay. So do you understand what that means? So you actually, when you have good time, not good time, but you actually allow some loss for your loan. Okay, so that's why this is actually in a parenthesis, meaning it's negative. Okay? So when you want to realize some loss, this is a count, so you can actually use for the first. Okay? First place to reduce. Anything else? Then I want to calculate this on the balance sheet risk-adjusted asset amount. So you can actually see this cash balance due from Fed, Treasury bills, Treasury, long-term Treasury securities, and the government agency long-term debts, then they are all 0%, right? Yes? So you actually sum them up and then multiply 0%. So that's a 0, yep? And bit more risky assets like items in process of collection, and then long-term government agencies and municipal bonds, and then loan to countries with OECD CRC rating 2, and that's all 20%, right? So you sum them up, right, and multiply by 2, so 0.2, right? And also, you sum them up, multiply by 0.5, sum them up, multiply by 1, sum them up, multiply by 1.5. Okay? So if you do that, then you have 764.5 million. Okay? So that's on the balance sheet risk-adjusted amount. Correct? Then next, what you want to have is calculation of these off-balance sheet items. What do we have? So here you have what? Contingent claim, right? So this is like a loan commitments, and then standby letters, and then commercial letters, right? So that's actually contingent claims. And here you have derivatives. Okay, you have interest rate swap, and you got euro-dollar contract, right? Then for contingent claim, you have to multiply the notional amount by some conversion factor, right? And then multiply by risk weight, right? And sum them up. That should be the way to calculate this. So here, here. So you have 3 items. So 2-year loan commitments, and then standby letter of credit and commercial letter of credit. So face value is actually given like that, and conversion factor is also given like this. Then you multiply these two together. Then you have this credit equivalent amount, and you multiply risk weight accordingly. Then you sum them up. Then from the contingent claim, you have $60 million risk-adjusted asset amount. Make sense? And next, you have 2 items, interest swap and then foreign exchange, so euro-dollar contract. The notional amount is 100 million and 40 million. Then using conversion factor, you can calculate this potential exposure, right? So this is like amount that you can lose in the future. So that is 0.5 million for the 4-year fixed floating interest rate swap, and 2 million for the euro-dollar contract. And you can also, you need to specify current exposure as well. So this is 3 million means you are losing 3 million at the moment, right, from this contract. And if you actually have 0 loss, or like if you have positive profit from this position, then you can actually set your exposure as a 0. Make sense? Then you sum them up, then that's this. Yes? So just the potential exposure plus current exposure, then that should be it. Then your credit equivalent amount is just 5.5%. Sorry, 5.5 million. So this amount is from the on the balance sheet. This 60 million is from contingent claim, and this 5.5 million is from derivatives, right? Then you have in total 830 million risk-adjusted amount of asset. Yes? Easy, right? Then what you do is you divide by 830, 830, and then 830 for the total capital, right? Then you have CET1 capital, 8.4%, and Tier 1 capital ratio, 9.6, and then total capital ratio, 13.6. So remember, to adequately capitalize, this one, the threshold was 4.5%, and that one is 6%, and that point was 8%, right? So you can actually say, in all criteria, this bank is adequately capitalized. Make sense? That's what you can say. So it's actually used more than enough. Any questions? Then lastly, we want to go through these additional capital requirements under Basel III. So like what I explained before. So this is added at the cost of 40 million loss in our GDP. It's actually lessened from the global financial crisis. Capital conservation buffer. So capital conservation buffer is like this. Okay, so in the good time, capital is actually circulating economies well. then banks are likely to make lots of profit, right? Then if you earn more profit, then put some portion of your profit aside, and then you actually use it as a buffer for the bad time. Don't use the taxpayers' money. That's the lesson, right? Don't really enjoy excessive bonus and things. So if you want to do this, then you actually do this first and then give bonus. So that we require like 2.5% of total risk-weighted asset, right? So additional 2.5 capital, depending on your risk asset size, right? Then you actually put it for the buffer for the bad time when you are in good time. Does it make sense? Yes? So prepare for the rainy days. That's our lesson. So that's actually called the buffer, capital conservation buffer. Okay? Similarly, you have this counter-cyclical capital buffer. So when economics is boom, it's kind of similar but slightly different because even though when economy is boom, you got some period like you don't have a rapid increase in economy. So its circulation of capital is not that fast. But if this is the case, circulation of capital is very fast, you would earn a lot of money, right, as a bank. Then you actually need to save some money when this speed actually slows down. For the cases that your speed of the circulation is to slow down. Then like something like this. So buffer between 0% to 2.5%, then you actually save the additional capital in case that your economy actually going slow down. Okay? So the aim is to protect the banking system and reduce the systematic exposure to economic downturns. So where losses in downturn can be particularly large and when downturn is preceded by a period of excessive credit growth. Okay? So you see the difference, right? So this is a kind of if you are in a good time, then save some money for the bad rainy days. And here, we actually stress more about the capital availability in the market. Does that make sense? So think about it this way. So if you're in a good time, but with a reasonable amount of capital in the market, even though you go to the recession, then capital shrink is not that huge. Does it make sense? But think about the era after the global financial crisis. We actually put a lot of money into the market, right? We had the abundant capital in the market. Yes? Does it make sense? And then we actually enjoyed the boom. Then once we actually going down from this boom, right? Then the impact will be much larger than the previous case. So you don't have much capital, adequate amount of capital in the market. Yes? Does that make sense? Because when there is too much capital in the market, or in the economy, right? Then you want to get it back much more than what you should. Does it make sense? So the availability of the money in the economy will be much smaller if you experience the expansion too much in terms of capital, in terms of credit. Does it make sense? Let me make some figure. So let's assume that so in the good period, let's say this was the amount of capital. So good period, it's also a good period, right? And let's assume that in the bad period, when you actually turn down to the recession, then let's say you cut half of credit available in the market, right? You want to get it back because you're uncertain about your counterparty, right? Then removing this much of money from this, removing that much of money from the market, from the economy, which one would be more devastating impact? Of course, this one, right? Yes? More entities will be affected, yes? So when you have this much of capital available in the market, then you have to prepare be more. Does it make sense? That's what this says. Counter-cyclical capital buffer. And this, globally systemically important banks, that's exactly this. So if you're this Bank of America, which is linked to the all the other banks in other large banks, right, in other countries, then you are more systemically important at global level. So you have to have 1 to 3.5% more capital buffer than other less systemically important bank at global level. Does it make sense? So you can actually see JP Morgan Chase, they are at the fourth bucket, which require them to have additional 2.5% capital buffer. And you got Citigroup, Deutsche Bank, and HSBC at the third level, which is 2% buffer. And Bank of America, Bank of China, Barclays, BNP Paribas, Goldman Sachs, and then Industrial and Commercial Bank of China Limited, Mitsubishi, Wells Fargo, they are in second. And all the other banks actually here in the first bank. So you don't really have much banks. But these banks are actually globally important bank. So once one of them actually default, then this impact will be large, very huge. Okay? Does it make sense? Okay. So this chapter is more about your knowledge. It's not much calculation and things, but you have to memorize lots of things. But like what's the changing, what added, what was lesson, and things like that. And similarly, if you actually think of this systematically important bank at global level, you can also think of it as a domestic level, right? Does it make sense? So you want to identify which bank in your economy, in your local economy, are important. Make sense? So in Australia, we have what? ANZ, NAB, Commonwealth, Westpac, four big four banks, right? So these are the systemically important banks in Australia. So they have to have additional 1% capital. Okay? And lastly, we want to talk about leverage ratio. So Tier 1 capital divided by total exposure. Okay? So what it means that you don't want to allow some banks to rely too much on the purchase liquidity management. Does it make sense? So for the liquidity management, you have two methods. One is stored, right? The other one is purchased. So stored means you use your own asset. So you encourage you to use stored liquidity management because purchase liquidity management is not always available. Especially for the crisis period, you can't borrow money from the other banks because they are not willing to lend money to you. Yes? So you want to restrict this leverage ratio. So here, under the standard approach, you actually measure your total exposure as on the balance sheet assets. So it's not unadjusted, right? So it's like what is your total amount of asset on your balance sheet? And then you actually put like a Tier 1 capital. Does it make sense? That's leverage ratio. And then for the advanced approach, then you want to include on the balance sheet asset plus off balance sheet exposure. Okay? Does it make sense? So you want to add some off balance sheet activities as well in your asset side. So it's the same thing. So derivative contracts, you actually calculate this way. Current exposure plus potential exposure. For the contingent claim, then you actually do conversion factor multiplication and then multiply by risk factor. Okay? Oh, sorry, you don't have the risk factor here because it should be normal thing. And in Australia, we don't have this at the moment, so it will be applied in 2022. So we have 4 years left. No, is it? 3. Okay. So we extensively discussed how we can calculate this capital adequacy ratio in terms of credit risk, but we haven't really talked about interest risk, market risk, and risk-based capital, right? So far, interest rate risk is not reflected in our capital adequacy ratio, okay? But we do have the requirement for the operational risk and market risk and risk-based capital. Okay? So think about this way. So original risk-based capital ratio take into account only credit risk, but your insolvency risk arising from duration mismatch and trading risk, okay, which is not reflected in your current calculation. So since 1998, you have to have add-on capital for your market risk. So meaning if you are trading excessively for the trading, assets, right? Meaning you actually trade the bonds and then equities and things as a bank, then you have to prepare more capital. So that's add-on. So two different approaches. BIS standardized model and financial institution or internal market risk model. So the second one refers to the VAR, okay? And then BIS standardized model is refers to the expected shortfall. So a similar method is proposed for the interest risk, but it's not formally required yet, okay? So that's the current status. And if you actually go to this link, then you can actually find out Commonwealth Bank's financial statements. So they actually calculate all the capital ratios, capital adequacy ratio for their banks. And then they also explicitly state what kind of business risk they have, what kind of risk they face, and things like that. So look at that. That will be beneficial for your understanding. Okay? So why they actually disclose this? Because it's required by regulator. Then you look at this report, and then you actually look at the financial status of the Commonwealth Bank. And if they seem to be risky, then you can actually move to the other bank. Right? So that actually introduced disciplinary action. So that's all for today. Any questions? Okay, so then before you actually go, can I ask you to complete the student survey? So you can do it now, or you can actually do it later. But when I usually ask, do it later, but people don't really do it. But we got kind of pushed by admin staff to increase our response rate. I'm actually asking this because this is my last lecture with you. Because next lecture will be covered by Sherry. And you can actually ask more questions about final exam. Right? So the last lecture will be about the off-balance sheet activities. So Sherry, NRIC, who actually made your final exam question, so she will cover the topic. Okay, so you can talk to her next week and ask lots of questions for exam. Although I don't think she's going to give you additional information rather than the announcement on Moodle. That's it. Any questions? All right, so I really enjoyed this class. So your active participation was quiet today, but I know because this is a boring stuff a little bit. So I really appreciate your participation this semester, and then I don't want to see you again next semester. Okay, don't waste your money. So start preparation of exam from today. Okay? Any questions? All good? Okay, thank you very much, and I'll see you in the exam place then. Thank you.
About the leverage ratio equation.
Leverage ratio, yes.
Yeah, what's the difference between the formal equation of Taiwan capital divided by the total risk-adjusted capital?
That one is actually risk-adjusted, and this one is not. So you see this?
Yes.
So even though you actually use advanced approach, it's like on-balance sheet asset and off-balance sheet asset. So here, where is it? Here, your 830, right? 830, that is like your asset amount multiplied by this risk weight, right? Depending on the riskiness of the each asset, you actually multiply that. But where is it? Yeah, but here, it's simply like you actually add everything here, right? And then not this. Everything here, and then you actually do conversion, but do not multiply this risk weight. Does it make sense? Yeah, that's pretty much it. So of course you don't really, I don't think you actually add this weight 01, but you actually add all of this risk weight, risky asset, and then your exposure to the off-balance activities. So you don't really adjust how risky your individual asset is. Yeah, that's the difference. Yeah. Anything else? Mm-hmm.
Planning to apply for the PhD next year.
Here.
Not exact. I haven't decided the place, which university
Okay.
apply for.
Is it Australia or somewhere else?
I have to choose Australia or the UK.
So, I think just one sec. I think that I can actually give you information. So, what is your objective of doing PhD? You want to be an academic?
I want to have a job at university. I like actually have a internship in my undergraduate. I found I was more prefer to the university.
Rather than industry.
Yes.
So, you want to get academic
Yes.
position.
Yes, that's my plan.
So, it's good, but let me just explain what's happening now. So basically, for the reference, I'm not the good person to get because usually references should come from the senior people, like a professor level.
Yes.
Yes. So like you have to see our faculty members like Professor something, because they are usually more well established and their name is well known. So like from junior faculties is not working anyway. And also, I'm not quite sure about the where you can go from now. So you haven't done any research before, right?
Yes. I have
So-
no research background.
So that would be a bit problematic.
Yes.
But still, I encourage you to apply. But because Australia is a pretty different system, because usually the research track is like this. So people do honors or like MPhil after the masters, and then they actually get some research experience, and then they come to the PhD class. And they do a bit of coursework, and they do write thesis, and that's it. Okay? But that sounds easy, but it's not easy process. And but for like overseas, like a PhD program overseas, especially US or UK, they actually train you from the scratch level, meaning coursework. You have to pass the core, meaning you have kind of comprehensive exam. So they will train you for the 1 or 2 years, and then they will give you exam for the entire unit you actually learned. So that's actually called the per exam. But in Australia, we don't have it. So like a pros and cons, I think that's actually good because you can actually learn a lot of things. But the level of learning is pretty different. You shouldn't expect something like this. So it would be more mathematical, usually. And then it's more like theories and empirics, and then you get familiar with what's going on, like some discussion I delivered the last lecture, at the end of the lecture. Do you remember like disciplinary action of the depositors and things like that? So this thing is like from my research experience. So you, as a PhD student, you have to have this kind of thing. So advantage, if you have very good score, maybe you have some chance, but you have to admit that all people getting into finance PhD, they have all good, excellent like a GPA. Yes. So so you have to, the good, more important thing is you have to have some experience in research. That's the first thing, like RAs or whatever. And then you have to have a good reference letter. So if it's from the famous people, so for example, in our school we have Professor Ron Marsalis, and he's very well known, especially in corporate finance area.
So he always
But
teaches the
he never teaches the
courses.
undergraduate or masters. He only teaches PhDs in law school. Yeah. So so basically means it's impossible to get a letter from him.
Yes.
Even PhDs, not every PhD in law school can actually get a letter from him. So the next strategy would be, so are you in last year?
Yes.
Then you have to actively, so which courses did you do?
You mean from the last year?
Yeah, from last year to this year.
5512, 5514, and also 5516,
Who were your lecturers?
maybe 5516. The Adam Christopher, and also the other another lecturer. I cannot call his name because I think it's not the English name.
I think Chris, so Chris, right? Chris.
Yes.
Chris is retired,
Yes.
but still, I think, okay to get a reference. He should be better than me. Yeah. So, I mean, if you don't have anyone, I'm happy for you to, happy for you, your referee. But what I'm saying is, you have to be strategic.
Yes.
So, because, okay, let me just frame it differently. So before getting into this industry like PhD or academia, looks good and it looks like kind of you enjoy your life. You got a balance between your life and things, but it's not. You know? Yeah. So if you actually, if I just raise an example, in my case, I normally spend more than 18 hours at school. Then I usually sleep 6 hours or 5 hours. So these days I don't have any personal life because I'm running for the conference submission and things like that, and then my JAMAC papers as well. So that thing is not that easy, and especially when you are getting into the good research school, meaning your obligation is not teaching is part of this, but this is not main thing. Your tenure, meaning your security of job, depends on your research performance.
Yes.
Yeah. So that is not that easy. Yeah.
Yes.
So for example, for the globally top 50 schools, or even, well, not even 50, it's like globally, let's say 100, then the minimum level, I think it is publishing at least 2 papers for top 6 journals. But that's not easy. So it looks like it's okay, but this is not easy anyway. So doing PhD means you becomes producers of knowledge from the consumer of knowledge. You are a consumer of knowledge now, and now you are changing yourself to the producer of knowledge, and that's research. Yeah. So and then people who are senior actually review your paper, and then they determine whether you produce enough incremental knowledge or like improvements in our current knowledge. If it is enough, then you accept it. If it's not, then you reject it for the journal publication. That's what's happening. But still, I'm not really saying you have to lower your standard or whatever, but you can try. But you have to practically think about where you can get a job if you get some admission from some schools. So for example, if you actually graduate our school, I feel our school is pretty good, but it's not obviously one of the best school in the world. So like in US, even probably from the faculty's level, we are kind of competing words 40 to 50 level.
Yes.
Yeah. So this is a faculty level, but PhD school level is actually lower. Also only because I think I don't know why. Anyway, so like PhD quality in general we do have very strong candidates,
Mm.
but placement of our school is not that great because normally people prefer to stay in Australia. So even though our previous PhD graduates actually having like interviews and a job offer from the overseas, they don't really go there because they want to stay in Australia. So it looks bad, that's why, but it's actually better than that. Yeah, so you can actually go better place than previous placement. But I'm not saying it's easy, it's very hard. It's very hard. And also practically you got some kind of limit that you can actually go. For example, you're from China, right?
Yes.
Then what is a good Chinese school? Like hacking? Probably you have a little chance, but not much.
Yes.
Because they, as long as they prefer to have a graduate from the very top schools,
Yes.
even though they are very bad at research.
Yeah.
Because the hacking, they only require, as long as I know, they only require one good journal publication. And then like Hong Kong universities like HKUST or like SMU or like Singapore ones and things,
Yeah.
they pay well, but it's way harder than getting into the hacking. Yeah. So probably if you're aiming those, our school is not a good choice. So what you should do is you should do a lot of research, meaning you go to their school's website and then you can actually see where is the placement of the previous PhD students. Yes, that should be your starting point, and then don't really restrict yourself to the U.S. or Australia. Okay? To begin with, you have to consider everywhere.
Yeah.
Because finance PhD, I said that our school is not that great in terms of PhD placements,
Mm-hmm.
but getting into our PhD is not easy.
Yes.
Not easy either. Usually we have one person from our graduates
Every year or
every year. Yeah. So very small room.
yes.
Yeah. So, well, probably you have a better chance in UK or US, right? So, but condition is you have to refine your research interest first. So what you want to
Yes.
do and then what.
Yeah, actually, I'm working hard in my research proposal, and I choose the topic. Actually,
What is it?
It is the combination of behavioral finance and asset pricing.
Okay.
It's the house sentiment index affects the stock price volatility.
To be
And
honest,
medium-
that's already done long
Yes,
ago.
yes, but the method I use, I think I use the medium-based to construct the.
Let me tell you the truth. My training is about the econometrics. So my
Yeah.
undergraduate, my master's, and then my earlier research is about the econometrics.
Yes.
In finance, methodological advance is not treated well
Mm-hmm.
unless it actually give us new intuition.
Mm-hmm.
So to be honest, if you actually write that as a proposal,
Yes.
your proposal will be trashed out.
Mm-hmm.
Yeah. So don't focus on methodology. Don't.
Yes.
So you have to read some articles,
Mhm.
right? And then think about, so mostly recent articles. So you have to, it's not, it's actually hard for you because you don't have any research training. What you have to do is you read some area that you're interested in and then see how this knowledge has been improved and then how people actually argued and things like that. And then if you can actually find some niche area, like you can actually make this much of improvement, that's good enough.
Yes.
So,
Actually,
but methodological improvement is
Mhm.
nothing
yeah.
unless it actually gives new intuition. Do you understand what I'm saying?
Yeah,
So-
actually, my past 2 months, I have done this job every day,
Mhm.
and I read the relevant articles and journals in
Which
these-
journals did you read?
Journals of finance, journals of financial economics, review of financial studies.
Okay,
journals
good,
of
good.
capital
That's
markets.
3 journals you have to read. Yes.
actually I choose this topic to mainly accept the methodology, and also I want to make the difference, the comparison, to compare the difference in market, developed market, emerging market.
That's exactly what I'm saying. So
And
that's exactly what I'm saying, like which you shouldn't do as a PhD student.
so what I should do in the PhD?
You have to give new understanding, new insight, something that people didn't know. So, for example, think about this way. So you are interested in the asset price, the relation between asset price and sentiment, right?
Yes.
And then I forgot the paper's prediction, but let's say people are more sentiment, and then in some area, then this one actually deviate the asset price from the fundamental level, right? So it's like kind of behavioral bias. Then we have plenty of studies like this in US, right? So once you actually find some finding in US, you actually do the exactly same thing using the Chinese data, but you find something different result, right?
Yes.
But maybe it's due to from institutional background in China, because you have more individual investors.
So I should control them. I should control the variables.
Yes, but still, like that's why you actually have this kind of difference. Then, if you control these kind of things, then you actually got the exact same result. It is not contribution at all. It's not a good enough contribution for the good paper.
So I choose maybe 20 countries.
Exactly what I'm saying is applying same thing to different countries is not a good paper. No. There should be some reason why looking at the same research question in different country is interesting. Do you understand what I'm saying?
You mean
Why we have to do this research again in different countries? Yes. So adding more countries doesn't make sense.
So I just group these maybe 20 countries into two groups: the emerging market and the developed market. And I want to know whether in the a mature market or still a developing market, they have a difference. The sentiment has a very functions different.
So the other way to think about this is why people haven't done this before. Usually, you have to think in this way. Well, time. I only have 10 more minutes.
Okay.
So usually, if you cannot find that paper, two reasons. One, not interesting at all. Second, we don't have a reason to do this. Because at your level, anything you can imagine, that should be done already, or like very easy to do.
Yes.
Yeah. But I'm not really saying I don't have any intention to decrease. I mean, discourage you, right? So it's more like what can I say? So at your level, in your research proposal, first you have to show you actually research in this area and you know what's going on here. That's first. And second, you have to provide some new angle to look at or add some more knowledge. As I said, you're actually you're entering to produce knowledge, right? So applying same thing at different countries or like a larger sample doesn't make any difference. You should justify this. Otherwise, it doesn't make sense. And from your saying, I can clearly say that's not good enough. Yeah.
So I think about another question is about the spillover effects. Whether the sentiment you constructed from the U.S. market, it also influences the other markets' volatility or just stock price returns.
Again, that's kind of a methodological, right? Yes.
Yeah.
So when you look at the papers in the top 3 journals you mentioned, then the reason that they got in that publication, that journal, is usually not methodological issue.
Yes.
Okay? It's like they actually found a new finding. That's it. So read introduction carefully, because introduction is the most important part for your research paper. So don't read all the other like methodological issues, whatever. Okay, and then read many articles as much as possible, as many as possible you can about the introduction. Then usually introduction looks like this: motivation, and then you actually show what you did, and then why this is important. So that's a three-part. Introduction is three-part. Motivation, why you should do this research, and second, what we found, and third, why this this finding is important. So look at this, and then find out try to understand what's the finding, why this finding is important, why it's not, and if this is finding true, what we can actually do more. Right? That should be the way to get a good research question. So what you've done is like, oh, so this is done, then what about this, what about that, without much reason. Okay? So better work is like you should have some good prediction beforehand. So it's hard, I know, at your level, because you haven't done anything. But it's like, for example, I'm not an expert in that area, the example you raised. But think about this way. So my research paper these days I'm working on is this. So people actually documented disciplinary action of depositors. So when the bank actually backing up some finance of the pipeline, do you remember this example, last lecture?
Yes.
Then they actually withdraw their deposit from this financially backing pipeline. Banks that are financially backing the pipeline, right? And then they actually deposit someone else. So they experience in decline in their deposit rate. So deposit share in local county. Okay. So then we got a bunch of effects like this. Well, why not we don't have any positive effect? So if your bank is doing good thing, do we actually see any kind of reward from the depositors? This is unknown. Yes? If it is known, this is not contribution. If this is unknown, that is contribution. You see the difference? So I'm not talking about anything about the methodologies. It's like recently, for years, we have some evidence that depositors actually give some disciplinary effect to the banks. So they look at the bank's action. If bank actually doing bad, then they withdraw their deposit and deposit to some good banks.
Yes.
Does that make sense?
Yeah.
So that's a disciplinary action, and that's actually only a negative effect for the a bank actually doing bad thing, right? I want to focus on what if bank actually doing good thing, seemingly doing good thing, like a donation, right? Then if bank actually donating to the local community, what kind of benefit they receive? It's not known at all, not researched at all. Does it make sense? That's why I do this. So firstly, usually they haven't done this because data is not there long ago. So usually data is something that you need to see, but that's not a big issue. The second, you have to come up with this kind of thing, right? So what is not done and what can be done in terms of the knowledge contribution. Does it make sense?
Yes.
So don't focus on any methodological part. Then it's less likely for you to get into good schools. Okay. So think about the contribution you can make by doing something. And also another advice is asset pricing.
Just a little about the asset pricing because I think no financial studies can work without the asset pricing.
Well, yes, as a PhD, you have to do both asset pricing courses and corporate finance courses. But generally, asset pricing studies are kind of harder to publish. Only because kind of, how can I say this? I'm not saying corporate finance is easier because you have more people.
Yes.
Yeah.
I think
Yeah.
lots of people.
Yeah, more people. And then corporate finance, doing good corporate finance is not easy at all
Yes.
because you got a whole bunch of endogeneity. Yeah. So that's something I can actually advise you. Yeah. Right. Yeah. And yeah. So it's good to know you apply for the PhD, but like first you have to very good motivation, and second you have to learn more, and third you have to search schools, and then see that you're fit, and then fourth practically think about what kind of placement do you have if you apply for this school. Well that thing is like you can decide that after you actually receive offer,
Yes.
and yeah, and then the most important thing for you is to find out the good research question.
Yes.
Otherwise, it's hard to get in because everyone is getting good score from their local schools.
Mm.
Yeah. Yeah. And then for the reference wise, find out better people than me. Yeah. Yeah. Because if you're applying for like let's say LSE or like a very good schools, they will never look at your CV, even CV if I'm your reference. Yeah. If the Ron is your reference, they will have a look at it, for sure. Yeah. But it's almost impossible for all the master students in you.
Yes.
Yeah. But still, you have chances to talk other senior faculty members. So at least associate professor level. So that's some people that you should consider first.
I think I haven't attended much courses because I only have 1.5 year time of master.
Yeah.
So I don't have much opportunities to go to many professors' courses.
But if you actually plan to do PhD, right, you should have done this from the very beginning.
Yes.
Yeah. So like you should have chosen your courses strategically. So like look at who's teaching this and then like yeah. Because normally this master's course in finance, that's not for the researchers.
Yes.
Yeah.
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 Actually, I should choose the research master in the beginning.
No, that thing you can't get in directly. You have to do master coursework first and then get into that. I don't think, unless you are outstanding or like something you have previous research exposure or something, I don't think our school actually accept anyone. So everyone I know, I don't know, I'm not quite sure. Anyways, usually they have the like coursework masters. People actually doing master by research here.
Yeah. One of my classmates, she's doing in the undergraduate with I don't know what's the name. It's just a 1 year study in the fall.
Honors, yes,
yes.
honors. Yeah, honors got a research component.
Yes.
So usually that's the kind of way to get into PhD, but it's not easy. So
he
like
is now doing PhD in the University of Sydney.
University of Sydney.
Yes.
That's easier to get in than our school.
Really?
Yes. So if you don't believe me, look at the like. Okay, so why do we want to go to good school? Because good school have better faculty members, meaning you got more quality supervision for your thesis. So they can advise you well and they can help you well and they know how to teach you. Right? But if they can only publish like a lower tier journal, then what's the point of doing PhD there?
So our school is much difficult to apply.
Yes. Our school is the best in Australia, especially in corporate finance. Yes, yes. Our school is the best in Australia. So if you look at the PhD placement in Melbourne, Melbourne is a competitor, Melbourne University. But PhD placement in Melbourne is pretty bad. It's way worse than ours. So our PhD is placed at Monash universities and then like other universities like Queensland and things like this. So that's kind of second tier in Australia. So UNSW Melbourne kind of competing, and then Monash, Sydney, and then like ANU is kind of in the middle, and then Monash, Sydney, and things like this, like combining together. Then we can actually place our students just one level below. But these guys cannot place to our school. Does that make sense? Because our school's quality, staff quality is way better than those other schools. Yeah. So our school don't really hire domestically; they only hire internationally. Yeah. Okay. So think about it, and then if you have any questions, then I'm more than happy to answer. So you can actually send me email or like an arrangement, and then I'm more than happy to help. But for the reference point, for your success, I don't think I'm the good person to do this. Now, I'm just telling you the truth. Yeah. It's not about my laziness or whatever. It's not. So to be competitive, first your research statement. Second is your first should be your reference, and then second the research statement, and third your record of academic record. Yeah. Yeah. So that should be the yeah. Okay. Good luck.
Thank you.
You're welcome. See you. Hello.
Hi.
Hey, how you going? Yes.
On the FAQs, it's like, oh, can you go over the word limit? And they say, oh, as long as it's not too much.
What does it mean?
I don't know, that's what I was sort of asking, like, word limit's 800, how much over
don't go over.